We're going to take a look at accounting for a note receivable. And so in our example, we have a company that received a 6-month 11% note for $60,000 from a customer who can pay their account. So what's happening here is the customer's account receivable is turning into a note receivable. They don't owe on account anymore. Now they owe on a note. So we're going to debit notes receivable for the $60,000 and credit accounts receivable for the $60,000. Now every day that goes by on the 6 months, we're earning interest revenue on this note. And if we receive the note and collect on it in the same period, we can just wait until the maturity date of the note when we collect the interest and record it as interest revenue at that point. But that's not what's happening here. Here, we received the note September 1st, 2018, and our year ends on December 31st, 2018. We're not going to collect on the note until March 1st of 2019. So we can't wait until we collect on the note in March to record the interest, because that means all the interest revenue would be reported in 2019. We have to make an adjusting entry on December 31st to accrue for the interest revenue that we have earned on this note receivable. So on December 31st, we're going to credit interest revenue, and we're going to see it works out to be $2,200 because we calculate it by taking the $60,000, multiplying it by the 11%, and 60,000 times 11% would give you a whole year of interest. But we haven't earned interest for a whole year. We've earned interest from September 1st to December 31st. So September, October, November, and December is 4 months of interest is what we've earned. So we're going to multiply that full year of interest by 4 divided by 12. So that's how we come up with $2,200 as the amount of interest revenue we have earned in 2018, right? And that's what we should be reporting on our income statement. Well, we're not going to collect that $2,200 until March of 2019. So as of December 31st, that $2,200 is owed to us. So we're going to debit interest receivable for $2,200 to show that we're owed that interest. Well, now when we come to March 1st of 2019, we're going to collect on that note, and we're not just going to collect the principal amount of the note, we're also going to collect the interest. So the notes receivable is going to get credited, right? They're not going to owe us on the note anymore, so note receivable goes down with a credit. We'll zero out that note receivable, and then we will debit cash, and the cash we're going to receive is $63,300. The $60,000 plus the interest revenue that we've earned over the 6th month. So we can see that works out to be $3,300, and we calculate that by taking the $60,000 times 11%. That'll give us a whole year of interest, and then multiply that by 6 divided by 12 because they owe us only 6 months of interest. So that's the $3,300. So the $60,000 on the note plus the $3,300 in interest means we're collecting cash of $63,300. Now, that $3,300 is the interest revenue we earned over the whole 6 months, but we've already reported $2,200 as interest revenue. And at the end of 2018, we said we were owed $2,200 as interest receivable. Well, it's not owed to us anymore because now we're collecting in full from our customer. So what we're going to do here is we're going to credit it's got a credit balance, debit balance, so we need to credit interest receivable for the $2,200 because it's not owed to us anymore. And then the last thing we need to do is we need to record the interest revenue for 2019. So in 2019, we have earned interest. $60,000 times 11% will give us a whole year of interest. But we've only earned interest for January and February, right? Because today's March 1st in 2019. So we multiply that by 2 divided by 12. So we've earned $1,100 of interest revenue in 2019. And so we can see this adds up to $63,300 in credits. We've got a debit of $63,300. So that's how you would account for your note receivable.